In the two previous videos, we talked about head and shoulders, reverse head and shoulders, double top, double bottom patterns. In this video, we're going to cover triangles, wedges, channels. These patterns are grouped together because they work as part of the structure of how we approach and analyze price action. You'll see how each of these patterns fit in our strategy and why they are so powerful when used as a set. Let's begin by breaking down the three core patterns. Starting with a triangle pattern, we'll explore its variations and how it fits in the broader picture of trend, continuation, and reversal. The triangle patterns comes in three variations, each with its own characteristics and market implications. Let's start with the ascending triangle. In the ascending triangle, the top side forms a resistant level as a price makes same high multiple times. The bottom side, however, forms higher lows, creating an upward sloping trend line. This pattern typically appears in both bullish and bearish markets. In a bullish ascending triangle, the price is in an uptrend leading to the formation of the pattern. The higher lows show that the buyers are gaining strength, and once the price breaks out of the resistance line, it confirms a continuation of the trend. In a bearish ascending triangle, the price starts in a downtrend. The higher lows show some buying pressure, but if the price breaks below the support level, it signals a continuation of the bearish trend. Next, we have the descending triangle. The bottom side forms a descending support level as the price hits the same low multiple times. Meanwhile, the top side forms lower highs, creating a downward sloping trend line. In a bullish descending triangle, the price is in an uptrend leading to the pattern. The lower highs show that selling pressure is increasing, but if the price breaks below the horizontal support level, it signals a potential trend reversal or continuation of the downtrend. In a bearish descending triangle, the price starts in a downtrend. The lower highs confirm that the sellers are in control, and if the price breaks below the support, the downtrend is likely to continue. Finally, we have the symmetrical triangle. In this variation, the top side makes lower highs, allowing for the descending trend line, while the bottom side form higher lows, allowing for an ascending trend line. This creates a tightening price range as the two lines converge. In a bullish symmetrical triangle, the price starts in an uptrend. The lower highs and higher lows indicate a consolidation period, but once the price breaks above the descending trend line, the uptrend is likely to continue. In a bearish symmetrical triangle, the price starts in a downtrend and the patterns indicates a pose in the market. And if the price breaks below the ascending trend line, it signals a continuation of the downtrend. Now it's important to understand a critical concept. When you are drawing lines to identifying patterns, treat them as approximation, not precise levels. The market is imperfect, and the patterns don't always form in a textbook picture-perfect manner. If you only wait for flawless patterns, you'll miss out on the majority of good trades because price movements are often noisy and far from perfect. To be a successful trader, you need to learn how to operate within this imperfect and sometimes chaotic market, adjusting and adapting as you detect patterns that may not be 100% perfect, but are still valid. We'll show you how to use these patterns in your trading strategy. But first, the next video will cover channel patterns.